Welcome to the Long Game Podcast, the show that helps you slow down, zoom out, and think long-term, because the best investment decisions aren't made in a hurry. Today, we're diving into something that many retail investors find intimidating, often overlook, or simply avoid altogether. But what if I told you that buried in this one document could be the clearest window into the soul of a company? I'm talking about the 10K. The 10K is not flashy. It doesn't come with glossy photos of smiling employees or visionary letters from the CEO printed in elegant font. It's long, dense, and full of legal language. But if you're serious about understanding the business behind the stock, this document might just be your best friend. So what exactly is a 10K? It's an annual report that public companies in the U.S. are legally required to file with the SEC, the Securities and Exchange Commission. Unlike the investor-friendly annual reports you find on a company's website, the 10K is written for regulators and investors who demand detail, not decoration. That's what makes it powerful. It's not designed to sell you a story. It's meant to tell the truth. And that, in the world of investing, is gold. If you want to think like a business owner, not just a stock trader, you have to understand the business itself. The 10K helps you do exactly that. But here's the challenge. Most people open a 10K and feel overwhelmed. The size, the structure, the language, it can all feel too much. So they give up. They scan a few numbers and move on, and in doing so, they miss the real opportunity. Because inside a 10K, you don't just see how much money a company made. You see how it thinks, where it's going, and what it fears. You see what management is proud of and what it's quietly trying to downplay. You see the actual guts of the machine. And when you read enough of them, you start to notice something strange. You begin to hear the voice of the company. Not the brand voice, not the marketing tone, but the real voice. The one that's trying to comply with legal obligations, avoid lawsuits, and reveal just enough to keep the regulators happy while also protecting competitive secrets. This is where the game gets interesting. You start to read between the lines. You start to notice what's not said, what's emphasized too much, and where the tone suddenly shifts from confidence to caution. The 10K is not just a report. It's a mirror. It reflects how transparent, honest, and competent the management really is. For value investors, people like you and me who want to buy great businesses at fair prices, this is the tool we use to separate signal from noise. Anyone can get excited about a hot stock on Reddit, but it takes discipline, curiosity, and a long-game mindset to sit down with a cup of coffee, open a 200-page 10K, and patiently read. And if you've never done it before, I want you to know this. It's not as hard as it looks. Yes, the first one is tough. You'll get confused. You'll Google a lot of terms. You'll probably yawn halfway through. But the second one gets easier. And the third one, you'll start to love it. Because you'll realize that while others are relying on opinions and noise, you're holding in your hands the raw source material. No interpretation, no filters, just the truth, straight from the business itself. And in a world where everyone wants shortcuts, reading a 10K is your unfair advantage. It grounds you. It slows you down. It forces you to think like a partner in the business, not just a gambler with a screen full of green and red. In the next part of this series, we'll walk through the actual structure of the 10K, section by section. You'll learn which parts you can skim and which parts you absolutely must not miss. But for now, I want to leave you with this one thought. When you pick up a 10K, you're not just reading a report. You're studying the anatomy of a business. And if you want to own a piece of that business for years to come, don't you owe it to yourself to understand how it breathes? This is the long game. And reading a 10K, truly reading it, is one of the clearest ways to play it.
Welcome back to The Long Game. In Part 1, we opened the door to the 10K, a document many avoid, but one that every serious investor should learn to love. Today, we're stepping through that door. Let's get familiar with what's inside. If you've ever opened a 10K, you probably noticed something right away. It's long. It's structured. It doesn't read like a blog post or a newsletter. It follows a strict format set by the SEC that every public company must follow. That's the good news. It means once you learn the structure, you can apply it to any 10K you pick up. Whether it's Apple or a tiny industrial firm in Ohio, the order is the same. The rules are the same, and that gives you an edge. The 10K is divided into several items, each labeled clearly. Item 1, Item 1A, Item 2, and so on. Most investors skim over these labels without thinking, but that's a mistake. These sections aren't random. Each one tells a different part of the company's story. Let's start at the top. Item 1 is called Business. It's where the company explains what it actually does. Sounds obvious, right? But you'd be surprised how many people buy stocks without really knowing what the business is. This section lays it out. Products, services, markets, competition, customers. It's like the company's dating profile. Who are they? What do they do? Where do they live? Who do they hang out with? If you only read one section when you're short on time, read this. Then comes Item 1A, Risk Factors. This is where things get interesting. The company lists every possible thing that could go wrong. Some risks are boilerplate. They show up in every 10K. Others are very specific, and those are the ones you want to pay attention to. It's like seeing what keeps management up at night. Now, here's a trick. Don't just read what the risks are. Look at how they're written. Are they generic and vague, or are they detailed, candid, even a bit uncomfortable? Companies that are honest here tend to be honest elsewhere, and that's the kind of management you want to partner with. Next, you'll hit items 2 through 6. Less exciting stuff about properties, legal proceedings, stock data. You can skim these unless something jumps out. A major lawsuit, for example, or a surprise real estate holding that makes you go, wait, why do they own that? But then comes the heart of the 10K. Item 7. Management's discussion and analysis of financial condition and results of operations, or as we call it, MD&A. This is where management explains what happened in the business that year in their own words. Not just the numbers, but the story behind the numbers. Revenue went up. Why? Margins fell. Why? Inventory spiked. What happened? This is where you learn to think like the people running the business. And here's the key. Read it like a conversation. Imagine the CEO sitting across the table from you explaining the past year. Are they open? Are they proud? Defensive? Evasive? Tone matters. If you read last year's MD&A and compare it to this year's, you'll start to see shifts. You'll catch phrases that repeat. You'll sense when confidence turns into caution, or when something big is being hinted at. This is detective work, and no analyst's summary will ever capture that nuance for you. Next up, Item 8, Financial Statements. We'll save the deep dive for Part 3, but just know this. Item 8 is where the hard numbers live. Income statement, balance sheet, cash flow, notes, the raw material for all your valuation work. After that, we move into executive compensation, corporate governance, and audit details. These sections might feel dry at first glance, but they're critical. How are executives paid? What are they incentivized to chase? Are bonuses tied to actual performance or just revenue growth? These answers can show you whether management is aligned with shareholders or with themselves. One more thing before we wrap today. The last pages of a 10K often feel like legal boilerplate, but sometimes, in the fine print, you'll find surprising gems. Wording about conflicts of interest, disclosures of related party transactions, even subtle warnings that something might not be as solid as it seems. So how do you actually read the whole thing without going crazy? Here's a simple strategy. Don't read it front to back in one go. Instead, jump to the most insightful parts first. Business, risk factors, MD&A. Then go into the financials. Use highlighters. Take notes. Read with a question in mind. Don't just read to finish. Read to understand. Because when you understand how a business works, how it survives, how it competes, how it grows, you make decisions with conviction. And conviction is what keeps you steady when the market shakes. That's what playing the long game is all about. Coming up in part 3, we'll get into the numbers. The big 3 financial statements. What to look for, what to question, and how to avoid being fooled by the surface-level shine. But for now, take a breath. You've just stepped into a world most investors never bother to enter. And that's why you're going to last longer. This is The Long Game. See you in the next part.
Welcome back to The Long Game. If you've made it this far, you've already done something most investors never do. You've not only opened a 10K, you've started to listen to what it's really saying. Today, we turn to the heartbeat of the 10K, the numbers. It's easy to feel lost here. Pages of figures, rows of revenues, expenses, assets, liabilities, earnings per share, line after line of data. But these numbers aren't just for accountants, they're for owners. And if you're investing in a business, if you're putting real money on the line, then understanding these numbers is not optional, it's essential. So where do we start? With what's called the core 3. The income statement, the balance sheet, and the cash flow statement. Together, they tell you how the company is performing, how healthy it is, and how cash really moves through the business. Let's begin with the income statement. It's also called the profit and loss statement. This is where you see how much money the company made in sales and how much it kept after all expenses were paid. Revenue at the top, net income at the bottom. Sounds simple, but here's where it gets tricky. A company can grow revenue every year and still be in trouble. Why? Because not all revenue is created equal. Sometimes it's driven by price increases, other times by temporary promotions or acquisitions. And sometimes that growth is masking falling margins, meaning the company is spending more and more just to make the same amount of money. That's why you don't just look at the numbers, you look at the trends. Are gross margins consistent? Are operating expenses eating into profits? Is net income growing at the same pace as sales? If not, you ask, why? Next comes the balance sheet. Think of it as a snapshot of what the company owns and owes at a single point in time. Assets on one side, things the company has, like cash, inventory, property. Liabilities and equity on the other, what the company owes and what's left for shareholders. The balance sheet tells you whether a company is built on solid ground or drowning in debt. But again, it's not just about the size of the numbers, it's about proportion.
How much of the assets are actually funded by debt? Are receivables growing faster than sales? That could mean customers aren't paying on time. Is inventory piling up? That might mean demand is slowing. Does the company have enough current assets to cover short-term liabilities? This is where ratios like current ratio, quick ratio, and debt to equity start to matter. But here's the secret. Don't memorize formulas. Instead, think like the business. If you ran this company, would you feel safe looking at that balance sheet? Would you sleep well at night? And finally, the cash flow statement. This is the one most beginners skip, but it's where truth lives. Because profits are easy to manipulate, but cash is harder to fake. The cash flow statement breaks things down into 3 buckets. Operating activities, cash generated or used in the core business. Investing activities, money spent on equipment, acquisitions, or investments. And financing activities, raising capital, paying down debt, buying back shares. If a company shows strong earnings, but poor operating cash flow, that's a red flag. It might mean revenue is booked but not yet collected. Or it could mean expenses are hidden in places the income statement won't show. But when operating cash flow is healthy, consistent, and growing, that's when you know the business is real. And if free cash flow, meaning operating cash minus capital expenditures, is positive year after year, you found something special. It means the company not only makes money, it keeps money. And that's what you want as a long-term investor. But don't stop there. Because hiding just beneath the surface of all these statements is something even more revealing. The footnotes. Most people skip them, but serious investors don't. These are the fine print explanations that give color to the numbers. They tell you about accounting methods, assumptions, one-time charges, stock-based compensation, revenue recognition policies, and more. And sometimes, buried in these notes, are the clues that explain why a number is higher or lower than it should be. It's where you find the truth behind the numbers. For example, a company may report lower net income this year, but in the notes, you find out they wrote down an asset that had nothing to do with core operations. That's not a bad sign. It might even be prudent management. Or maybe a company suddenly shows huge revenue growth, but in the notes, you learn they changed how they recognize revenue this year. Without that context, you might misread the trend. That's why the footnotes matter. They're not just legal fluff. They're the story between the lines. And as you read, always remember, no single number tells the whole story. It's the connections between numbers. It's the consistency between words and numbers. It's the gap between earnings and cash. That's where insight lives. That's where conviction is born. In Part 4, we'll take it even further. We'll talk about red flags, subtle signs that something might be off, and how to use the 10K to see the character of the company, not just its results. But for now, take this with you. The financial statements are not just for analysts. They are the language of business. And if you want to be an investor, not a speculator, you've got to learn to listen. This is the long game. See you in the final part.
Welcome back to the long game. We've looked at the structure of the 10K, walked through its core sections, and explored how to read the numbers like a business owner. Now comes the final step. Not just reading what's written, but noticing what's missing.
This is where you stop being a passive reader and start becoming an investigator. Because inside every 10K, beyond the charts and figures, beyond the carefully chosen words, there are subtle cues, clues that can tell you whether this company deserves your trust or just wants your money. Let's start with one of the most overlooked sections in any 10K, executive compensation. When you open this part of the filing, don't just glance at how much the CEO is getting paid. Ask why. Is the compensation tied to long-term results, like return on invested capital or free cash flow over multiple years? Or is it tied to short-term revenue growth, stock price movements, or even vague performance targets? Because how executives are paid reveals what they'll chase. And if they're incentivized to boost metrics that look good in the short term, like top-line growth or share price spikes, they might do things that hurt the business in the long run, just to meet those targets. But when compensation is tied to metrics that reflect real, durable performance, when the goals are multi-year, thoughtful, and aligned with shareholder outcomes, you're looking at a team that's thinking beyond the next quarter. That matters. Now, let's look at another subtle signal: related party transactions. Most 10Ks include a section where the company discloses any business conducted with insiders, the CEO's cousin supplying office furniture, or the chairman's other company leasing space to the business. These things aren't always bad, but they deserve scrutiny. Because when insiders are doing business with themselves, it raises a simple question. Is this deal good for shareholders or just good for them? You want management that avoids even the appearance of self-dealing. That builds trust over time. Next, keep an eye on auditor opinion. This is the part of the 10K where external auditors sign off on the company's financials. Most of the time, they issue what's called an unqualified opinion. That's good. It means the financials fairly represent the company's position. But if you ever see the words qualified opinion or going concern, slow down. That could mean the auditors found something troubling, maybe irregular accounting or serious doubts about the company's ability to survive. Even if the rest of the 10K looks fine, an auditor waving a yellow flag means you need to investigate further. Now, let's talk about tone. Yes, tone. Even in a formal legal document like the 10K, tone matters. Read enough of them, and you'll start to hear the voice of the company. Are they open about mistakes? Do they explain tough years with clarity? Or do they gloss over problems with vague language and fluffy optimism? A company that owns its flaws, that speaks plainly even when the news isn't great, that's a company worth listening to. Because honesty isn't just good ethics, it's good business. Finally, let's talk about patterns. If you read just one 10K, you get a snapshot. But if you read 3 years in a row, you get a story. And if you read 5, you get a history. This is where the long game really kicks in. You see how the business evolves. You see whether promises made in 1 year show up as results in the next. You see how risks emerge, how priorities shift, and whether strategy stays consistent or flips with every trend. This is what separates surface-level research from deep understanding. Anyone can read headlines, but real investors read patterns. And those patterns are what build conviction. Now, let's be honest. Reading 10Ks is not thrilling. You won't get a dopamine hit like you do from watching stock prices bounce or scrolling market news. But that's exactly why it works. Because when you read the 10K, you're doing what most won't. You're building your edge, not through speed or speculation, but through insight.
You're learning to see the business, not just the ticker. To think in years, not quarters. To seek truth, not hype. And that's what the long game is all about. So here's your challenge. Pick a company you admire. Download its latest 10K. Print it if you can. Grab a pen. Start reading, slowly, thoughtfully. Write down your questions, highlight what surprises you, compare this year to last year, and most of all, listen closely. Because inside that dry, dense, jargon-filled document is a business, with people, choices, values, mistakes, and dreams. And if you listen carefully enough, you'll hear its heartbeat. You'll hear what others miss. And you'll be that rare kind of investor, one who plays the long game not just with your money, but with your mind. Thanks for listening. Keep reading, keep learning, and keep playing the long game.